to the new administration and trying to figure out how to handle now the handover from how the Biden administration had dealt with the chips industry, particularly as it pertained to China. How do you see the biggest difference playing out?
I think that's the problem. I don't think there is going to be a difference. I mean, if anything, the Biden administration has been sort of conservative and listened to the hawks and become increasingly hawkish on China and use the chip industry as a vehicle to exert influence. Hard to imagine that from what we saw last time that the Trump administration will be any different or if not more hawkish. So I think we can, at the moment, the consensus is that we will see more tension.
Right. Ian, thank you so very much for your reporting. And of course, don't miss his big take on Bloomberg.com and on the Bloomberg Terminal about SoftBank's ambitions. Now, coming up next, we're going to talk about the wildest trades of 2024, how it sets up for a wild trade ahead. We're going to bring in Bloomberg's Emily Griffeo for that. Stick with us. This is Bloomberg.
A continent of vast opportunity and endless potential, but not without its challenges. Bloomberg highlights the players and unpacks the issues shaping the African story. We'll bring you interviews with key newsmakers and expert analysis, getting to the heart of business, politics, and economics in the region. I'm Jennifer Zabasaja, and this is Africa Amplified.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture. It's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names in business are on Bloomberg.
We are in the midst of the largest wealth transfer in history right at this very moment. So $100 trillion of wealth is going to next-gen and millennial clients over the next decade. So that has some pretty significant implications. But in addition to that, women are controlling more and more global wealth. Today, they control 1/3 of global wealth, but in the next 5 years, 30 trillion is going to pass in the hands of women, and they're going to control over 50% of the global wealth market out there today. Women care deeply about investing with purpose, investing to make an impact, doing good with their investments. So you're going to see some significant opportunities for us as we lean in and have been leaning in to capturing more of the female wallet globally.
Nobody covers business like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Welcome to our TV and radio audiences, back to Bloomberg Markets. I'm Katie Greifeld alongside Shonali Bassick, bringing you home through the end of 2024. It has been a wild year. At least markets taking a little bit of a breather right now. Volume, of course, falling off a cliff. But we do have a little bit of green on the screen.
We have green on the screen. We have red on the screen, too. And I really was drawn to the red this morning. And the reason was you do have an S&P 500 rebounding. Thank goodness. We are in the green, 0.3% higher in the day. We are led higher by the NASDAQ 100. And you're watching the 10-year yield way above that danger zone of 450. We're now at 457. But I want to flip up the board here and also look at one sector that had been going gangbusters all year long. That is crypto. And you are not only far off that 100,000 level, you are now at 93,300 per Bitcoin. And it's leading certain crypto-related stocks lower. MicroStrategy is your worst performer in that NASDAQ 100. You have really, of course, the NASDAQ shaking off that crypto pain. MicroStrategy down almost 5% this morning, this afternoon now, I guess. Coinbase also down 3.6%, but largely, let's be honest, these were huge gainers this year. What's a little relief?
Yeah, it is pretty wild. You consider where Bitcoin entered 2024 at about 43,000 or so. It has been a wild ride, not just in crypto, but it feels like in every asset class. So let's bring in Bloomberg's Emily Grafeo, of course, from our cross-asset team over at Bloomberg News. Talk us through some of the wildest trades that we saw in 2024.
So I'll start just with Bitcoin. For anyone who thinks that this is still a trade that's on the fringes of Wall Street, it definitely came right in the center this year. Look no further than what the ETF flows look like, because BlackRock's Bitcoin ETF was the third most inflows for any ETF. It was right up there with S&P 500
That was like the most successful launch ever. Are we safe to say that now?
I think we're safe to say that now, especially when you look at just how many billions piled into that ETF. But even when you go a little bit more, I guess, specific into the ETF space, one of the really big trades was leveraged ETFs. They're called single stock ETFs, Katie. As you know,
I dream about them.
They really amp up the volatility in stocks. So NVDL is one that comes to mind when I think of biggest trades of 2024, because this was an ETF that had 200 million in assets at the beginning of the year. It peaked at 6.7 billion. It's come down a little bit as NVIDIA has kind of come back a little bit, but it goes 2x NVIDIA, and it just captured retail investor attention this year. It's up over 350%, again, because it 2x's NVIDIA's daily.
Okay, so 350 sounds like a lot, but there are places where you saw gains much larger, and they're in much more esoteric places. The place where you saw 2,900% payoff was an esoteric market in Spain. Talk about it. This is a bond that was issued by a bank that was taken over by another bank, and then what happened here and who saw the trade?
Yeah, this was an incredible chart. This is from our FX team. If you look at it, it is literally just a vertical line up. Like you said, a 2,900% gain in the span of seconds. Basically, a bond was issued in the early aughts by a bank that was then taken over by a bank that was taken over by another bank. And I guess when the note was issued, it just absolutely spiked up. It was a bank from Santander, and it was left for dead. It jumped back to life for some seconds and then immediately went back down. Santander never said much about why it made the payment. Observers speculate it was related to the tidying up of its balance sheet.
Coming into this year, you also saw some concerns over some weaker parts of the market, distressed trades, commercial real estate trades, yet you also saw people make money there.
Yeah, I guess the AI euphoria was really carrying that. And even if you go to other parts of the world, international markets, China was a trade that was kind of up and down all year. But when you look at what their major stock benchmark did, just for the full year, up 14%. So pretty good there, considering that over the summer, people were really kind of going in and out of China, and there was a ton of volatility. Obviously, that's underperforming the U.S., but it's not terrible.
I just had to point out some of these more niche trades because that's what these people get paid for, Katie. It's not just buying Bitcoin and letting it stand.
Well, I'm going to keep it really simple because let's talk about cash. You think about the hottest trades of 2024. This has been a hot trade for years now, and you have $7 trillion in money market funds despite all of these speculative fringes that we've been talking about.
That's right. That was a record, which is surprising because this was supposed to be a year that rates were coming down, people were moving the cash off the sidelines, and yet the fourth straight year that Treasury bonds underperformed cash. You look at an index of U.S. Treasuries, it gained 0.7% on average this year, compared with a 5.1% return on T-bills. So the T-bill and chill trade worked again for the fourth straight year.
Emily, we thank you so much for keeping an eye on all the wild trades, the ones that are obvious and not so obvious. We're going to go now to Priya Misra. She's portfolio manager with JP Morgan Investment Management. We're talking about cash being king, and a lot of people still wanting to hold cash going into 2025. How do you think about the dynamics happening between cash markets, treasury markets, money markets, everything that feels safe but offers you just a little bit of different return?
Sure, thanks for having me. So I would say cash has felt good for the last few years, right? The Fed was raising rates aggressively. They were behind the curve on inflation. Cash felt great then. We came into this year with the market pricing in 7 rate cuts, and cash did better than treasuries. But I would say let's take stock now. I'm glad you start with cash because for the first time after the Fed rate cut last week, front-end yields are actually, or cash is yielding less than treasuries. And if you add on some spread there, I would say, we're in a soft landing, the economy is strong. You look at high-quality spread product, you're getting 5.5%, 6%. You go into securitized or you go into high yield, high-quality high yield that we like, double B, single B, 7%. And now you're looking at a big give up. If you're staying in cash at 4%, because that's where Fed funds is, you're actually giving up a few percentage points. So I think fixed income, slightly longer duration fixed income, gives you income. And importantly, I know we were just talking about these wild trades and trades that do great. In an environment where there's a lot of uncertainty, I think fixed income is giving you that diversification. We saw it a few times this year when stocks fell. What worked? It was longer dated fixed income.
So longer dated fixed income, here are the numbers that make me nervous. You look at the 10-year falling in September to as low as 3.6%. Then you see it now at 4.6% nearly, almost a full percentage point higher in a matter of months. So what's the case for duration with that type of volatility, especially if you think that, there is more upside in yields here at the longer ends of the curve?
So a couple of points on that. You talk about longer end. I would say up until the 10-year, I think that's sort of the area that we would like, 5 to 10-year. I think when you start going into the 30-year, given the deficit trajectory, term premium can increase some more. So I do think you have to be careful where you are on that curve. Second point, valuation. I'm glad you bring up where we were in September. I mean, in September, the market was concerned around the labor market because we've just had those 2-week payroll reports. We're concerned about how much more can the Fed cut. Look at how much we have repriced. We're pricing in only one more rate cut. The terminal rate is priced at about 4%. I think that's fair. I can see a scenario where the Fed cuts more. I think they just told us last week there's a lot of uncertainty. They think inflation will be sticky. But what if you don't get a pro-growth policy early on next year? And inflation, we do think that the disinflation forces are still in play. So there's a case where the Fed might cut more. I think we look at valuation, and there's value that's been created. So I hear you. It's hard to say that 4.6 is the absolute peak in the 10-year. As we get closer to a higher level, so 4.75, 5%, I do think the equity market's going to start to pay attention to bonds again. And that's where that equilibrating mechanism will come in between bonds and stocks. Bonds are still the diversifier. In an environment where inflation's heading lower, the Fed is focused on the dual mandate. I do think if you either get weak data or you get rates rising much more, people are going to look at risk-adjusted return and say, if I can get 6%, 7% in stable fixed income, isn't that better than buying the S&P, which is going to give you maybe 10%? I think that calculation starts coming in.
A lot to dig into there. I look forward to a future where the equity market is paying attention to the bond market because it feels like for months they've been telling 2 different stories, so you have to have 2 narratives in mind. But you mentioned that, of course, you can see a case where the Fed cuts more than what's expected. Can you see a case where actually the Fed hikes rates, is forced to raise rates in 2025?
So the scenario of hiking, I think, requires pro-growth and higher inflation. So if you get fiscal easing somehow, which I don't see something next year at all, because the the 2017 tax cuts expire only at the end of next year. I think we're going to spend all of 2025 dealing with the debt ceiling, spending cuts, DOGE, or how do we pay for the TCGA extension plus the additional tax cuts. But let's say there's an aha moment in Congress, they extend the debt ceiling and they give us big tax cuts next year, early next year, in which case you're getting deficit finance, tax cuts, pro-growth. I think that's a scenario where it's better growth and higher inflation. The Fed might be talking about hikes. In all of the other scenarios, I see either stagflation. It's not clear that the Fed hikes. If you get tariffs or you get, big immigration pullback, which results in higher wages but lower growth. In a lot of the other scenarios, I see two-sided risks. So there I see a Fed that's nervous, takes a step off. They've already cut 100 basis points. They've been calling it the recalibration phase. They stay on hold. I see that. So if I think about all the scenarios, I see them cutting a few more times, but really cautiously because they're nervous about all the policy risks and what combination of growth and inflation are we going to get.
Well, let's bring this conversation to the corporate credit market, because you think about, of course, the Fed maybe cautiously cutting, as you say. You think about all the different cross currents that you have on the fiscal side. How does that play out when it comes to IG, but also junk as well?
Sure. So I would say we should, IG, and I would say the high quality, high yield market or the junk market, we would classify as solid companies, good balance sheets, good earnings. We look at what they're doing with the debt they're raising. They're not re-levering up. They're actually paying off certain expenses. They're, refinancing debt. There's not a whole lot of re-leveraging that's going on. So the fundamentals look really strong. Now you're going to look at spreads and say spreads are really tight, and I say yes, but for good reason. And then I look at technicals. In terms of the money that we talked about, money sitting on the sidelines, money is coming into bond funds further out the curve. I still think there's a lot more money that's chasing these all-in yields if you're getting 6-7%, and that's what's keeping those spreads that tight. So, do I think spreads will tighten a lot more? It's difficult to see a lot more tightening, but you just get that carry. You get that additional 100 basis points in investment-grade corporate, or 150 or 200. The CCC part, I would little bit stay away there. It's extremely idiosyncratic. You have to know what you own. I think dispersion is very high in that part of the curve. But the high-quality corporate sector, I think, is tight for very good reason here.
Priya, we have about a minute left here, and you were talking about the 30-year and the uncertainty around it. And then you look at 30-year mortgages, looking at the 7% level, high for a generation, right? So what kind of concerns do you have around the spillover effects of mortgage rates staying that high?
I think I'm glad you bring that up. For all the talk that monetary policy is not restrictive, the housing market is a clear metric that it is restrictive. Housing affordability is an issue, and now with mortgage rates where they are, I think the housing market remains frozen, meaning people stay stuck in their, it's a good thing that they locked in low mortgage rates, but they're not going to move out. So what this means is less mortgage supply. I think housing remains a drag for the economy. May not be enough to push us into a recession, but I do think from the economic standpoint, it's a negative. We also like mortgage debt because, you're not going to get a lot of net supply of mortgages. So we think some combination of corporates as well as mortgage-backed securities is attractive.
All right, Priya, it's great to see you, of course, before we end 2024. Happy holidays when you get there. That is Priya Misra of JP Morgan Investment Management. Now, coming up, we'll have a look at how the EU is regulating tech and some of the challenges they're facing in the new year with the new U.S. administration. That conversation next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. but there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
We're scaling up at incredible pace.
This region is growing so rapidly. The opportunity is really huge.
Only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Television and Radio. Shonali Basak here alongside Katie Greifeld, and we're looking at how policymakers around the world have been grappling with a key trade-off, and that's between making sure firms don't dominate an industry and that those same firms have the incentives to innovate and grow and help drive the economy. And it's a trade-off being made differently between the U.S. and the EU. Bloomberg's Max Ramsey reports.
The European economy is facing a slow agony as it struggles to compete with the US and China. So said none other than former ECB President Mario Draghi in September, pointing to sluggish growth and productivity. The numbers help show the scale of the gap between Europe and the US. Despite having a larger population, the European Union's GDP sits at around $19 trillion. That's compared to $29 trillion for the US. The Stock 600's market cap is about $14 trillion versus over $50 trillion for the S&P 500. One criticism has been that Brussels' aggressive approach to regulation, especially with big technology companies, has held corporate Europe back versus its global rivals. The person at the center of this policy for the past decade is Margrethe Vestager, the EU's former competition commissioner. We spoke to her on her final day as the bloc's top antitrust enforcer.
What has been sort of my drive in Danish politics, in European politics, was to make sure that everybody has a fair chance of making it. And making sure that the market provides for that the market serves customers. That has been, the trend of these 10 years for me.
It's a mantra that has resulted in some of the toughest rules in the world for big tech. Another way to put it, if you can't beat Silicon Valley at its own game, regulate it. Vestager has overseen some of the EU's most high-profile cases, taking on the world's biggest companies and issuing over 25 billion euros in fines for abuses of dominance and cartel violations.
Today is a big win.
She won a record 13 billion euro tax judgment against Apple and oversaw one of the EU's landmark pieces of regulation, the Digital Markets Act.
On a Sunday?
We asked about her rise from Danish politician to perhaps the most feared name in Silicon Valley.
I don't really know how to prepare for being on the front page of one of the U.S. main papers. It's important to figure out how to go with it.
Fair is fair.
I came, of course, from executive positions in Denmark. I was the deputy prime minister. I had several experiences as a minister. But I think the most important point is that you believe in what you do. That's the cases that we have fought, that they have been fought with great work by the teams with very strong evidence. I think that's the kind of preparedness that you need, that you believe that this is a strong case and you have something valuable to say.
But today, Vestager's legacy faces a challenge from those who say regulation has hurt Europe, stopping it from creating massive technology companies to rival the US or China. We put this to Roxanne Vaza, a woman at the very heart of Europe's tech scene.
How would I sum up US versus Europe regulation? Well, I mean, I think Europe definitely has the image and the reputation
reputation of always wanting to regulate, and they're good at it. Regulation does, in some cases, slow things down. It creates complexity. In some cases, it's not even clear when the regulations are first coming out exactly what they apply to and what we need to do to comply with them. So it can be quite difficult to navigate, especially for young, innovative companies that don't have a lot of resources and a lot of time to spend on that kind of thing.
Margareta Vestager takes a different view.
We are talking a lot these days about competitiveness. The paradox is that you can have competition without having competitiveness, but you cannot have competitiveness without competition. So really important to maintain that strive that everybody should be challenged. If you achieve a very strong market position, it comes with responsibility. So to some degree, I think a lot of people can mirror themselves in what we are asking of market participants in their own lives. If someone is rich and powerful, they have responsibility. If someone is small with very few means, well, they should have a better chance of making it.
This view has informed the flagship technology regulation for the EU and, by extension, much of the world over the past 10 years.
I think it's important here to see, well, some regulation, like the Digital Markets Act, is opening the marketplace. Regulation like the AI Act makes AI safe to use, which means, again, that it opens the market for many more use cases where people may otherwise scare off.
And that was Bloomberg's Max Ramsey. And let's stick with Europe now and go to France for the latest on the country's new cabinet. President Emmanuel Macron naming Eric Lombard as finance minister in the last hour. Bloomberg's Benoit Berthelot is here with us from Paris. So what is the first item on the to-do list for Eric Lombard?
It will be for sure to pass a budget for next year, so for 2025. That will be the main task for this government, really. A budget is very political, obviously. It indicates the directions a government wants to take in terms of fighting against inflation, and all the topics that are the most political, security, etc. Now, the budget for next year hasn't been approved so far, and since Emmanuel Macron has been dissolving the assembly this summer and taking down the assembly, he has no majority, no clear majority in parliament. There are three forces: the far left, the far right, and a centrist bloc. And the first government he nominated has been toppled. So it's the second government since this summer, and we'll see if he has the capacity to pass this budget without being toppled and actually make a compromise with all the political groups. It's clearly not an easy task that he has ahead.
What do we know about Eric Lombard? Because as you've mentioned, this is a budget that has led to a lot of political fractions already. What might he do differently in terms of negotiating the path forward?
He's not known by the French, really. He's been a banker for a good part of his life at BNP, at Generali, and right now he was previously the head of the Caisse des Dépôts, which is a sort of public bank that deals with social housing. He could be seen as a left-wing figure. He's been with socialist governments before, but still someone who's very plugged in the economy, and he wants a responsible finance. He wants to finance the fight against climate change. He's been known for saying there is too much inequality in France, the wealthy being too wealthy, that sort of things. The good thing for him is he's not known, so he hasn't had fights with the far right or the far left, and he's sort of a neutral, maybe older figure. So that's what he has for him. But now he's going to face the same challenges that the previous government has been facing.
And, okay, so we're getting part of the new cabinet here. Eric Lombard, obviously named just this morning. What else should we be keeping an eye on?
So it's a mix of politicians from the left or that are close to the left, like former Prime Minister Elisabeth Borne, like another former Prime Minister, Manuel Valls, who are back at the government. So there are lots of veterans and well-known figures, and there are also right-wing ministers who were previously with Macron. Macron has been known to be, as he said, a centrist, taking from all sides and creating a new way to do politics, but it's a lot of veterans and personalities that are well known by the French. So it doesn't give an impression of being a very fresh or a very new take on politics, to be honest.
That is Bloomberg's Benoit Berthelot in Paris. Thank you so very much. Of course, a lot going on in France right now. You know, it's interesting. Let's just chat markets here for a moment here, because we did start on a down day, Katie, and, you know, we are seeing that start to turn around. Light volumes, but a generally optimistic view?
Yeah, I mean, it's hard. On December 23rd, you have to take any move with a huge grain of salt. When it comes to volume, at least by my screen, on the S&P 500 trading volume off by 20% from the 20-day average, which you would imagine, but you do see gains extending, at least for right now. The S&P 500 up 0.4%, coming off of 2 straight weeks of losses.
I don't know about you, but after this, I'm going Christmas shopping, because I have not yet finished, and we're going to talk to Morning Consult about retail trends and the consumer health moving forward. This is Bloomberg. Stick with us.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into, because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
The top names in global leadership are on Bloomberg.
When it comes to tariffs, we need to be very clear. The European Union is negotiating as a whole, so there's no room to have bilateral agreements. It's a core competency of the Commission. But speaking about the art of the deal, I think a deal can be made when it comes to the U.S.-European trade relations.
Nobody covers the top global leaders like Bloomberg. Context changes everything.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture. It's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
In New York, I'm Manus Cranny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, welcome back to Bloomberg Markets on TV and radio, of course. It's the end of the year, so we're doing our simulcast. I think this is radio on TV rather than TV on the radio because we're sitting in the radio studio, which we don't normally do.
Paper covers rock.
There you go, yeah. Not that it matters truly, but in any case, we are looking at these markets. We're looking at green on the screen. Again, hard to see too much conviction on December 23rd, but of course, we're capping off an extraordinary year for the markets, and there's a lot of question marks heading into next year.
Question marks, and there are a few in particular you and I have been talking about all morning, and that is those presented by Torsten Slok over at Apollo. Let's start talking through them. And you know what? We're also going to bring in Bloomberg's Alex Semenova to talk about them with us, too, because some of them are kind of a little more obvious, right? Yeah. You know, the number one thing on Torsten's list is tariffs coming, a 90% chance that they're coming. He doesn't tell you how fast or drastically they're coming, but they're coming.
Yeah, yeah. And Alex, I will be honest, I saw that you tweeted this, and it motivated me to open the email, which I did. But yeah, let's talk about that. The 90% probability on tariffs, but also on NVIDIA earnings, disappointed, inflated expectations.
Yeah, this list is certainly getting a lot of attention. Obviously, you know, we know that we're going to have some tariffs on the way. The Trump administration has been touting that for a very long time now. And then NVIDIA, of course, the expectations are so sky high that it is very likely that if they don't hit the mark on their results, then investors would, you know, will immediately find an opportunity to sell. But the interesting risks that stood out to me here are the probability of a U.S. recession at 0%.
That's a big call.
Anytime you assign, you know, odds that are at either 0% or 100%, investors should be wary. I had one source, IB, chat me today, and he said that if Torsten is selling his recession odds, then I'm a buyer, because this, again, sometimes people see this as a contrarian take.
And the beauty of Torsten Slok at Apollo is who we're talking about. The beauty of his notes is that they're so bite-sized. They're just quick to the point. He doesn't really elaborate. I would love to hear what's behind the conviction for a 0% odds of recession in 2025.
Yeah, especially because, you know, we talked to Jay Hatfield a little earlier at Infrastructure Capital Partners. He was talking about how he also doesn't see a recession, but he sees a growth slowdown. So there's a lot of nuance here. Even if it's not a recession, then do you have to worry? Listen, guys, as somebody who had to, frankly, embarrassingly hire 3 tutors to get through my statistics classes.
You're not alone, Chanelli.
It's a tough one, but what I love is not where there's 100% or 0% chance, but where there's something more in the middle. So he sees that there's a 40% chance that the U.S. 10-year interest rate rises above 5% before mid-year. That means he believes more than not that it won't, right? But that 40% chance, we're at 4.6% right now.
Yeah, you want to have disagreement on Wall Street. You want to have people kind of crowding around the middle rather than on one side.
There's 2 sides to a trade, I've heard before.
That's how people make money.
And so we remember what happened when at some point we were polling economists and people were expecting a 100% chance of a recession, and that never materialized. So a 0% chance is something to be concerned about. And obviously that means that the risk of probability of a recession rising, that itself is going to be a risk. If that increases, that could be something that investors are watching, and that could be disappointing.
Well, this marries nicely into something else that he sees 40% odds of. And he also did note that several of these risks can materialize at the same time, which is hence we're not adding up to 100 here. But he said there's a 40% chance that the Fed raises interest rates in 2025. And it seems like Wall Street is digesting, of course, that dot plot, the view that maybe the Fed is only going to cut twice in 2025, but when it comes to actually talking about rate hikes, I feel like not a lot of people are pricing that in.
Yeah, not at this point. We saw investors recalibrating those expectations last week, and of course got the worst day, the worst Fed day, I think, ever. Was it on
I think it was on a scheduled Fed day. It was the worst performance for the S&P 500 since 2001.
Right, and so we're seeing some of the implications of that. If that continues to be a concern that interest rates will go back up, then of course that is going to disappoint equity markets, because in the year ahead outlooks, no one is really talking about rates being a big concern for investors at this point, and obviously they are.
I want to go back to that kind of 90% chance here, because this is, I think, the most surprising, that NVIDIA earnings disappoints inflated expectations. 90% chance. We went into this year, that being the golden trade of the year. There's another potentially golden trade brewing under the market, one that I need a little explaining of. Can you explain to me what's going on with quantum?
Yeah, so quantum computing is the new hot topic going into 2025. Of course, investors have been enamored with AI, which means that they've been seeking opportunities to capitalize on that momentum outside of AI semiconductors. And this seems to be one of those sectors that is kind of adjacent to that trade. If you look at some of the stocks today in that segment, D-Wave, Quantum, Rigetti Computing, each up more than 20%. Quantum computing also having an incredible run. And this is, of course, largely driven by optimism around Alphabet's Willow chip capabilities. The Google parent said that this chip was a breakthrough, and that helped it rise about 30% off of its September low, and of course sent its peers higher. But I want to reiterate to Shonali's point, a very important point here is that this is a thematic trade at this point, solely trading on the potential of it. Because if you look at the fundamentals, they're not quite adding up. Look at D-Wave Quantum. It has a roughly $1.8 billion market cap and $9 million in revenue. Wow. So not a lot to show for it at this point, but it hasn't stopped these stocks from their run. Rigetti Computing up 1,007% this year.
A lot of fun disconnects there between valuations and actual fundamentals. Let's switch gears entirely and talk about Playa Hotels and Resorts. You think about big movers today, we are seeing a skyrocket to the upside.
Yeah, that stock is up about 28% right now, and this is after it agreed to exclusively negotiate with Hyatt Hotels about potential strategic alternatives, including a potential acquisition. So this news is making investors quite happy. It is seeing its biggest intraday gains since November 2022, the highest level in more than 7 years on this news. And Hyatt said that it does not intend to comment further on these discussions until they are finalized. I was looking at some of the analyst commentary. Truist says that it is no surprise that Playa is interested in, being a seller because it believes that its shares are undervalued. And they said, while it's hardly a done deal, we see a greater likelihood than not that this transaction will be completed.
Just kind of to relate this back to Torsten's risks.
Yeah.
M&A IPO rebounding, 75% chance. You're seeing wins of that. In this season, want to talk about another deal out there in talks at the moment, Nordstrom. What's going on here? Because this has been a deal that a lot of investors have been talking about, and you've seen the stock fluctuating, but not to the upside. It's down almost 1.8% right now.
Yeah, so the Nordstrom family is taking the company private in an all-cash deal. It's valued at about $6.25 billion, including debt. This is with the help of Mexican retailer El Puerto de Liverpool. The family will own about 50% of the company, while basically it's a 50-50 even deal, and Nordstrom common shareholders will receive $24.25 in cash for each share. The deal is supposed to close in the first half of 2025. Basically, the founding family thinks that the retail chain will be more successful if it's not under the scrutiny of public markets. Shares of Nordstrom have had a pretty terrible run, down about 40% in the last 5 years. When you look at the Russell 1000 index by comparison, it's up more than 80%. So really trying to get it off of the public markets there, thinking that the company will do much better.
Alex, we are grateful for you. Of course, that is Alex Semenova of Bloomberg News, keeping an eye on these equity markets. We are now going to broaden out. We're going to bring in Kayla Brunn. She is the lead economist at Morning Consult. We're going to talk about what she's seeing under the hood. Kayla, you think about what we're seeing. A lot of this market has been driven by one-off desires of companies making strategic moves. Where it's been really hard to get a read is the consumer. Even though you've seen a lot of strength, you have seen some companies still suffer from the bifurcation you've been seeing in the consumer. Where are the greatest strengths? Where are the greatest weaknesses?
Well, it's interesting because we seem to be at a little bit of an inflection point. What we've seen for sure over the last couple of years, as you kind of alluded to, there has been a pretty major bifurcation among consumers. I think that explains there's this gap between these pretty strong aggregate numbers you see for retail sales and consumer spending versus what you're hearing from companies about declining foot traffic, things like that. One metric that we've been watching very closely at Morning Consult that we create with our daily data actually is our consumer health index. And I think that kind of helped to tell the story that we saw in 2024 for retailers in particular. Over the summer, we saw a pretty big slump in that consumer health index, which tracks pretty closely with kind of spending. It's sort of a macro indicator of consumer demand and spending momentum. And we really saw a slump in the middle of the year at the time when we were hearing certain stores reporting declining foot traffic, more price price sensitivity, things like that. And it was driven in large part by those lower and middle income consumers, whereas higher income consumers continued to spend and kind of prop up those top line values. Since that time, however, we have been seeing a bit of a turnaround the last few months. We've seen pretty strong recovery, and it's actually happening not just among the higher income adults, but in the lower and middle income cohorts as well.
Well, what do you make of the Consumer Conference Board data this morning? This idea that politics is starting to play a bigger role?
I was a little surprised by the results this morning because we do have a daily sentiment index that we look at too. The questions we ask are more closely aligned with the University of Michigan, which showed a little bit more of a stronger reading. But the Conference Board numbers seem to show that consumers are actually pricing in a little bit of risk in their assessments of the economy looking ahead to 2025. And I say that because most of the drop that we saw in those Conference Board numbers were driven by expectations. It does seem like factors like tariffs are starting to weigh more on the consumer mindset, mainly because they're so primed to be concerned about inflation because price levels are still pretty high in the consumer perspective.
Well, also, you think about the University of Michigan poll that we got recently. It showed a surge in the share of people who believe that they should buy durable goods now to avoid higher prices in the future. Of course, interesting to marry that together with the Conference Board numbers that we got today and some of the details we got on how consumers are thinking about tariffs. But are you seeing any evidence of people pulling forward purchases ahead of higher prices, ahead of tariffs, for example?
Well, in the retail data, for example, it's tough to distinguish exactly because we did also, there's sort of hurricane impacts in the auto category, for example. You know, that's a big, large, durable good. But so it could be some having to do with hurricanes, some having to do with pull forward those purchases. What I can say is that consumers, we just surveyed them on how they feel about tariffs, and on net, for all the different categories we asked about, including large durables, there was net opposition to adding tariffs. So it really does seem to be something consumers are worried about. Another finding from that survey that I thought was kind of telling for how people are looking at 2025 is that we asked about, thinking back to 2018, the last time Trump was in office and implemented some tariffs, what was consumers' recollection of that? They did remember their costs increasing. That being said, they are expecting that if any of these policies that are put forward for 2025 go through, which, as you were saying, someone at least thinks there's a 90% chance, there seem to be pretty high odds, they are expecting that the impact would be much worse and much more inflationary on their household purchases.
Interesting. And Kayla, we talk about sort of this cost-conscious consumer all the time where people are looking for discounts, for deals, but are there any areas where it seems like consumers are still willing to spend up, willing and maybe looking to splurge?
Well, there's price sensitivity, which we track, and we look at that as sort of walking away from a purchase that they considered. That's kind of a total loss. Another type of behavior that we're seeing pretty elevated is trading down. I think that's why you've seen these differences in different store types. Sort of some are reporting, like Walmart at times is saying, oh, we're getting great foot traffic, higher earners are coming in, we're doing great. And then Target is saying, nah, we're having slow sales, things are not going as well. So consumers trading down is a thing that we're seeing. Going back to the retail report, to me, when I saw that the online sales, aside from auto, was the big driver in the increase in November, that tells me, oh yes, that's a good place for consumers to sort of compare prices, get the best bargain. So anywhere where where prices are a little more competitive, consumers are happy to have that relief.
All right, a timely conversation, of course, on December 23rd. Kayla, great to spend some time with you. That is Kayla Bruin, senior economist at the Morning Consult. Now, coming up, Apple wants to take on Amazon with a smart doorbell. More on that coming up next. This is Bloomberg.
The top names in business are on Bloomberg.
We are in the midst of the largest wealth transfer in history right at this very moment. So $100 trillion of wealth is going to next-gen and millennial clients over the next decade. So that has some pretty significant implications. But in addition to that, women are controlling more and more global wealth. Today, they control a third of global wealth, but in the next 5 years, 30 trillion is going to pass in the hands of women, and they're going to control over 50% of the global wealth market out there today. Women care deeply about investing with purpose, investing to make an impact, doing good with their investments. So you're going to see some significant opportunities for us as we lean in and have been leaning in to capturing more of the female wallet globally.
Nobody covers business like Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Continent of vast opportunity and endless potential, but not without its challenges. Bloomberg highlights the players and unpacks the issues shaping the African story. We'll bring you interviews with key newsmakers and expert analysis, getting to the heart of business, politics, and economics in the region. I'm Jennifer Zabasaja, and this is Africa Amplified.
Welcome to our Bloomberg television and radio audiences. I'm Shonali Basak alongside Katie Greifeld, and you're watching Bloomberg Markets. San Francisco Fed President Mary Daly said she is very comfortable with policymakers' median projection of 2 interest rate cuts next year. She spoke with Bloomberg after the latest Fed decision. Take a listen.
It's about the data. It's always about the data for me. We don't know what the incoming administration is going to do. You know, new administrations, no matter when they come, always put a slate of programs together. And really, as a policymaker, I want to see the net effects once I see clarity about what those policies will be. So I was focused on the incoming information and what it means for the outlook. And today, I feel like we've got policy in a good place, the economy's in a good place, and we're prepared for whatever comes before us.
What happened in the past 3 months that caused the Fed and perhaps yourself to be much more concerned about the stickiness in inflation?
Well, the data happened, and you look at the data, and what's happened is that there's 2 things that have occurred. First of all, the economy remains in a good place, and the risks to the outlook are equally balanced between a risk to inflation or a risk to employment. That's where we wanted our goals to be. And we adjusted policy when we had confidence that inflation was heading down, and we adjusted policy some more to ensure that we have a balanced labor market that continues. So that's where we are. But then the data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress has just slowed relative to what we had wanted, but that's a typical pattern. It's bumpy as you get to the, from 2.5 or 2.8 to 2, it's just a bumpy path. Go ahead, please.
But at the same time, some people were wondering if there was this stickiness, and I'm looking right now at, say, the Cleveland CPI now, and it actually has ticked up for the month of December from November. There was this question, why did the Fed cut it all?
Sure, and again, I'm going to reassert that it's bumpy. Remember earlier in the year, we had 2 months of data and people said, oh my gosh, it's reaccelerating, and then we had it come down. So inflation data, you can't focus on 1 month or 2 months. The most important thing for me was that we needed to recalibrate policy. I saw this as a close call. Was 75 enough to be the recalibration we were looking for, right-sized policy to meet the economy we expect, or do we need more? Ultimately, I determined that the 100 basis points was really the right level. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. We've practiced that where with a lot of uncertainty, you adjust the policy rate, then you wait watchfully, and you see what transpires, and then you make further adjustments. That's the phase I think we're now entering.
And that was San Francisco Fed President Mary Daly speaking with Bloomberg, and you can find that full interview on the terminal or online. Let's switch gears, though, back to tech, because Apple is considering challenging Amazon's Ring with a new home device that connects to smart locks. That story, of course, coming from Bloomberg's Mark Gurman, and I'm pleased to say he joins us now. So, Mark, talk us through your reporting and what you've learned about this bid by Apple.
Yeah, thanks for having me. So let me just take a step back here. In February of 2024, so actually earlier this year, Apple canceled a self-driving car project. For years, this was supposed to be Apple's next big thing after the iPhone, after the iPad, right? After the Vision Pro, which obviously hasn't had much success at this point. But they canceled that project. And after canceling it, they really pivoted into three new areas: AI, the smart home, and robotics. 2024 for Apple was very strong for AI with Apple Intelligence. And when I say strong, I mean in terms of their focus. The product is not so good, but they put a lot of eggs in the AI basket for 2024. The robotics work, the fruit of that is still many years away. They're working and exploring on humanoid robots, a tabletop robotic device that uses a new voice assistant. But more imminently, for 2025, going into next year, the focus is all about the smart home. The first device you're going to see from Apple in that space is what's known as a home hub. It's between 6 and 7 inches as a display. It looks like a squared iPad. You put it on your wall like you might put an ADT security system, or you can put it on your desk, and you can control all your smart home appliances. But for Apple, that's really the hub at the center. What they want to do is create an ecosystem of accessories around that hub. So they have HomeKit, they have third-party accessories, but they're also working on a few internally. And one of those, to your point, is a new smart doorbell. Now, this doorbell would compete with Ring and Nest and Logitech and other companies. And the big differentiator there is it would have Face ID. That's the same security technology for unlocking your iPhone or your iPad. And the idea is you can scan your face when walking into your house to unlock your door, just like you would scan your face to unlock your iPad or iPhone. And then it would work wirelessly with third-party or a partner deadbolt lock to unlock that lock for your door. And so that's what they're thinking in terms of one of their first in-house smart home accessories.
What's the arms race look like here, Mark? Because to your point, if they're trying to compete, so for example with Nest, and somebody has already fitted their house with, say, Nest, the heating for systems across their home, then why would they get a security system from Apple?
A really good point. So Apple actually has cooked up a solution to that in partnership with Amazon and Google. There's a new standard called Thread, which helps devices from different companies for the smart home be interoperable and work closely together. And then there's another protocol within the Thread ecosystem called Matter, which is sort of the language that they all speak and connect. So there's going to be a future where Apple, Amazon, Google, and smart home devices from other companies are able to talk to each other. So you can have a home. Obviously, Apple would prefer that all your smart home equipment is from them, right? But you can theoretically have a home where you're mixing and matching different hardware from Amazon, Google, and Apple, and they'll all run on the same wireless protocols to be interoperable, and so they'll all work together. So that limitation, to your point, exists today, but it really won't in the near future.
I want to talk about how investors are receiving this, because Apple shares hit an all-time high on Friday. Of course, the shares are up about 33% on a total return basis. I mean, it's hard to look at that and say that investors are unsatisfied, but is this what Wall Street and, of course, the investment community is asking for? What do they want to see from Apple in 2025?
Well, the investment community is asking for big improvements to AI, but if I'm going to just be honest here and riff for a second, it doesn't appear that the investment community cares too much or understands how behind Apple is in artificial intelligence. At the end of the day, the Apple story is tied to how many iPhones they sell and how many hardware products they sell. And it doesn't seem like at this point consumers or investors, if you look at the stock price, care too much that Apple Intelligence is probably 2 or 3 years behind, maybe more, the initiatives we're seeing from Google, OpenAI, and even Microsoft, other companies like Anthropic, even the AI engine Llama from Meta as well. So investors just don't care. They care about the hardware sales. The hardware is not selling as well, perhaps, as some had anticipated, but it's selling well enough to get people to keep buying those shares. What Apple investors have to understand is that there's no major hit coming from Apple at this point, right? There's no iPhone-sized next ball game for Apple, right? There's nothing like the car coming, so they have to understand that.
But wouldn't investors, are there a camp of investors here that believe that some of these other items are a distraction? If you're making laptops, then what's the point of you making a doorbell?
Well, it's not a distraction because in terms of revenue growth, you really need you really need a big new category, and that big new category is going to come. So let's break this down mathematically, right? Let's say investors, when they have dreams at night, they want a new $50 billion a year or $100 billion a year revenue category from Apple, right? A single product. That's not going to happen. But they need to get to that dollar amount. Apple knows this. And so the way to do that is sort of stack them, right? Instead of having one big bet, that's not going to happen, stack a bunch of smaller bets, right? So you can stack augmented reality with the smart home, with AI hardware, with the doorbell, with other initiatives. There's a foldable iPad coming in a few years. They're going to expand the iPhone line with a few new models over the next 3 years. So in terms of growth, it's really adding a bunch of smaller bets, stack them up like a skyscraper, and that's how you'll get that $100 billion a year growth.
Mark, we got to leave it there. We thank you so much for your time. Happy holidays. That is Mark Gurman.
Happy holidays.
Amazing reporting here. I've got to say, what I would really love is Apple or another existing technology provider to control my car.
I don't know. That feels kind of dystopian to me. I just want, a dumb phone. Well, I do want Twitter on my phone, but a dumb phone with Twitter. And I don't know. I want my car to not have a brain. But in any case, should we talk about these markets?
We should.
Yeah, we have green on the screen. You take a look at the S&P 500. Even though we're looking at a 0.5% gain, it's pretty evenly split when you take a look at up gainers and decliners. So we'll see what happens between now and 4 p.m. We have not a lot of volume. Anything could happen.
Anything could happen, but so far what has happened is we took that frown upside down, I suppose. We were on a down day, now we're up, and a smooth way to end the year. Just a couple days left of it, Katie, and one that was full of surprises. This has been Bloomberg Markets. I'm Shonali Bassick alongside Grady Greifeld. Have a happy holiday. Stick with us through the close.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
We feel strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just you're singing?
No, I'm spoken word.
Or spoken, sorry.
My voice is my conversation, my poetry, you know.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Monday. Happy Christmas before Christmas Eve. I'm Alex Steele alongside Vonnie Quinn, and this is Bloomberg Markets. Vonnie, you were on vacation for 2 weeks. Welcome back.
I was. I had to use up my days before the end of the year, and I can't believe there's still, 5 more trading days after today in the year, Alex, but we're essentially done, right?
Yeah, exactly. I was saying, let's be honest. Let's look at the volume here. You're looking at the S&P up 0.5%. The NASDAQ is up 0.9%. Vonnie, we're still at 57 record closes so far for the S&P, but can we trust this price action when volume is so light?
And bear in mind, last week was a heavy volume day, but we are down 70% from Friday's trading volume, which will just tell you where people have gone for the rest of the year. Treasuries, though, Alex, reacting to the higher for longer schema, and we are up today. We are steepening. And bear in mind, if you had started the year where we are now and done nothing would have changed in your portfolio. You literally didn't make or lose anything. You wanted to have been trading volatility in treasuries this year to have made anything.
And really, when you think about it, usually you go away on vacation, you come back and everything's the same, but this time you did miss stuff. The Fed, the higher for longer scenario, that bear steepener really playing out, right? You mentioned it, the 10-year yield up 6 basis points. We're at 4.58. You would not have necessarily expected that a few weeks ago.
No, and I was in Berlin, so I was able to get service on my terminal, so I was actually sneaking a look because it was just too fascinating to keep watching this market action, Alex. Wednesday, Thursday, Friday in particular, you saw so many reversals, so many changes of mind. And then again, at the end of the year, we are pretty much where we were last year. We have analysts looking for another 10% or more for the S&P 500 for next year.
You were on your terminal on vacation?
I was.
That's like a fine. I make people pay $5 when they do things like that. So we're going to take you updated on all the market moving action, plus take a look at some of the economic data. We have the Consumer Conference board out today. We have Dana Peterson on. She's going to kind of walk us through those numbers, which is quite interesting. Also, we have some CEOs on. A CEO of RXO, a logistic company, talking about demand and also tariffs and what we're doing there. So that should be quite interesting. We have all that for you. So let's get a broader chat here on what we are doing in terms of fixed income. We mentioned those bear steepeners. Carissa McDonough is fixed income strategist over at Community Bank Trust Services, and she joins us now. Is a bear steepener the way forward here? Is this what we should keep expecting?
Yes, thanks so much for having me. This is actually a perfect environment for that steepening trade. As we've seen, with the possibly new fiscal policies out with the new administration, or at least chatter about how inflationary those might be, that has served to push up longer term yields. But, 2-year yields in are really locked to Fed policy. So those yields are going to continue to possibly come down, even while longer term yields are going to be moving up. Yes, absolutely bear steepener. That's a money-making trade, we believe, for 2025.
How many cuts are you anticipating for 2025? I'm assuming that you're anticipating a couple of cuts at least. And do we definitely pause in January now, Carissa?
Yes, we think that 2 cuts is a reasonable place to go. Keep in mind that this full percentage point of cuts that we've had since September, that's the biggest set of cuts that we've had in a non-crisis environment ever from the Fed. So this is a really kind of new territory. They're working on curbing the inflationary environment from post-COVID. So I think it's still reasonable to possibly look for 2, but post-2025, there needs to be some some more convergence between Fed expectations and market expectations, because the market thinks Fed is done after that. Fed still has some cuts priced in.
So you think the market view will be right and the Fed's going to come to the market, in which case hence the steepening trade, et cetera?
Yes, exactly. We think, possibly 2 more and then done. The data really needs to speak for itself. So that's what we're looking for going forward.
What will cause it, Carissa? Do you anticipate any kind of surprises when it comes to growth, for example, or any of the economic data, inflation data?
That's an excellent question. I think inflation coming down, we've seemed to have gotten stuck a little bit at the mid 2% level. We saw PCE coming down. It was somewhat of a relief, but if you have kind of the average over time, PCE is still in the mid to high 2%. So we think that we need to see that continue to come down for a Fed to be really comfortable with another couple sets of cuts. But there's a lot of wild cards that could happen. Again, inflationary policies in the new administration, it's not clear to what degree those might pass, but that could really throw a wrinkle into policy and kind of keep rates where they are. So that, I think it makes a lot of sense for the Fed to pause right now and then see what happens after January.
Right, and really like after January 20th, because that's when we're going to get new policy. Yes. And you even heard the Bank of Canada today, we got the minutes out from their last meeting, talking about how the uncertainty with the U.S. Is definitely causing question marks when it comes to the loonie, and then how you price that in. We also saw some of the Fed officials also talked about the fact that they did look at potential tariff policy in their decision-making for that December 18th meeting. How do you look at that?
Yeah, well, it's so interesting. I think that there's been a real kind of change, and maybe we're going back to the way things used to be. But back in the Greenspan days, he would sometimes chastise the fiscal policy makers. This is not, this is too inflationary, et cetera. Powell has really removed himself from that. He's just kept to kind of the rate setting and not really dipped his toe into opining on fiscal policy. But I think we're seeing a return to that. And we're seeing, I think that last meeting must have been extremely contentious, just the way the dot plot changed and expectations changed. The fact that expectation of inflationary policy is really fed into policymakers' actions, or at least monetary policymakers' actions and forecasts.
Yeah, we're really at the last mile here, and we have been for some time. It is proving to be difficult. Carissa, characterize the year for us for fixed income investors. Was it a disappointment in the end, in the sense that we sort of are where we were at the beginning of the year now?
Yeah, it was a tough year. We thought we finally had that. I talked about the curve steepener trade, but it was much more of a bull steepener that we anticipated. We thought that we were possibly headed towards quite a bit more slow growth, possible recession when you have the curve is positive again. Historically, that's been the signal, but we ended up right back where we began, and I think as of today, maybe the Bloomberg Ag was up 1% or something along those lines. But it was a real roller coaster for not a lot of return. And I think this is something that even in an era of higher neutral rates, as we've seen the Fed is resetting possibly higher, I think lower returns and fixed income in general is something that we need to get used to as we're trying to figure out to what extent fiscal policy is going to impact growth and therefore rates. So this is how it's going to be, unfortunately.
Before we let you go, corporate credit, where is the sweet spot, or where in the credit market do you like?
Excellent question. Generally speaking, corporate credit, too expensive, tightest spreads in 25 years. We like the systemically important banks. We think that they will benefit from a deregulation type environment and the steeper curve, as we discussed. So finance spreads do carry a premium, a little few more basis points than the rest of the corporate market. So that's where we would look. And we also like mortgages, those two places.
You like mortgages. We're seeing the, sort of average mortgage top 7% at the moment. Given that you're only anticipating 2 Fed cuts for next year, and it does take time for these things to trickle into the real economy, do those mortgage rates change?
It's not so much those as much as it's a question of who's buying the mortgages and mortgage paper. The spreads remain compelling. Current coupon yields is above the Fed funds rate. We think that supports demand for mortgages from banks. So that's part of why we continue to be positive on the sector.
All right, Carissa, thanks a lot. We really appreciate it. Thank you so much for joining us. Carissa McDonough, Fixed Income Strategist, Community Bank Trust Services. Thank you so much for joining us. All right, well, let's get more on the currency market in particular, right? Because if you have that bear steepener and you have higher yields in the back end, guess what? The dollar also does really well. And you can just see in the Bloomberg Dollar Index having a tremendous couple of weeks and a tremendous year. Vincent Signorella is Bloomberg Macro Strategist, and he joins us now. Vincent, is the path of least resistance a stronger dollar, but what does it break?
It's going to break the yen, unfortunately, for Japan. I mean, whether that's a good thing for them or not. When you look at yields in particular, I'm doing something. This will come out on the blog probably in about an hour. The last time we broke 4.4% on the 2-year as a higher yield, the yields in the two-year went to 5%, and that took dollar-yen about 14, 15 big figures. So if we see something similar today, we can see a dollar-yen in the range of eventually around 170, 172. I think it's a realistic possibility. When I talk to traders, everyone's scratching their heads in terms of what they think interest rates are going to do next year. But the reality of the situation, I think the majority of people really don't see an aggressive Fed rate cutting cycle at all. If anything, they see inflation picking up with an administration with potential tariffs. And even without the tariffs, it's going to be a spendy administration, regardless of what Musk does. And we're going to see higher deficits. We're going to see tax cuts. It's just not an environment where you usually see rate cuts happen.
If we did get something like that, a yen above 170, I mean, that would be huge whiplash for the BOJ, right? That's 20 full figures for, the BOJ within just a few months. Would monetary policy be able to handle that, Vince?
They've handled worse. It depends whether or not it's orderly, which it likely will be. I don't think the markets are going to attack the BOJ and try to take it there in a very, very aggressive, very short space of time. They're likely to do it sporadically and over time. And the BOJ tends to allow yen weakness or allow fluctuations in the currency when it's done over time and it's done orderly. It's when it gets maddening is when they intervene. I mean, I'm not saying they won't intervene. They probably will to smooth things out if it does go up that high. But I don't think, realistically, one central bank can't change the course of a currency. It's going to need coordinated intervention if that's what they really want to do. And I'm not sure the other central banks are going to be participating in that effort.
What about emerging markets? I know you're the G10 guy, so I hear you on the yen, but clearly Brazil has been struggling. Just take a look at the past week and how many interventions they've had to get into there. What breaks on the EM side?
I think you hit the nail on the head. Brazil's definitely going to have some struggles. It's going to be interesting to see how Mexico's peso performs, to see what the Trump administration has in store for Mexico. I think when you look at North America, you have to favor Canada over Mexico as much as the incoming president has said he wants to kind of go after them with tariffs. It's more likely he'll do a deal with Canada than he will with Mexico. Mexico's been a source of contention for him for quite some time. So I think the Mexican peso is going to have some issues, as well as the Brazilian real.
What about in terms of correlations now that we're coming to year end, Vince? What can we say is new about correlations? We have, as Alex said, the Bloomberg Dollar Index, really strengthening, DXY above 108 right now. At the same time, Bitcoin is just above $93,000 and gold as well is off its highs, but very close to them. So what can we say relative to the US dollar for these other asset classes?
Well, I think going forward into 2025, I think you're probably going to want to like gold. You're probably going to want to like Bitcoin. I think while the dollar is going to outperform in the short run, if we do see tariffs, if we do see that kind of a situation with the budget deficit increasing, you're going to see some deterioration in the current account and such, and that tends to weigh on the dollar. And if we get inflation, even though we're going to see higher rates, you're probably likely to see lower real interest rates, and that will eat away at the dollar's advance as well. So I think at some point, maybe after the first quarter, this bull rally for the dollar will stall.
Yes.
We very likely could see the dollar lower by year end.
Vince, thank you so much. Always great to speak with you. That is Vince Signorella of Bloomberg News. Next up, we're going to be talking Amazon because we have some workers on strike, members of the Teamsters, joining in the walkout in Queens this past weekend. We'll be talking about Amazon next. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
We're scaling up at incredible pace.
This region is growing so rapidly. The opportunity is really huge.
Only on Bloomberg. Context changes everything.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture. It's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Names in global leadership are on Bloomberg.
When it comes to tariffs, we need to be very clear. The European Union is negotiating as a whole, so there's no room to have bilateral agreements. It's a core competency of the Commission. But speaking about the art of the deal, I think a deal can be made when it comes to the U.S.-European trade relations.
Nobody covers the top global leaders like Bloomberg. Context changes everything.
Welcome to Bloomberg Markets. I'm Bonnie Quinn alongside Alex Steele here in New York City, and we do have a little Santa Claus rally on our hands, Alex.
Santa Claus rally, but like a tired one. Can I say that? Because volume is still pretty light. But nonetheless, S&P is up 0.5%, and the NASDAQ is up by almost a full 1 percentage point. But it's not very broad. I mean, it's still a weak breath situation because it's all about tech and chips that are leading the way.
Exactly, and of course it is a sort of a relief rally as well after the Federal Reserve decision last week. Really spun out of control in the stock market.
Yeah, it did. All right, let's take a look at Amazon stock. Amazon is up by about 0.5%, but what we are seeing is continued targeting by the Teamsters as strikes really expand. Amazon workers now, the JFK 8 warehouse in New York City's Staten Island joined a strike by the International Brotherhood of Teamsters. It's growing. Want to get more on this with Spencer Soper. He joins us from our Seattle office. Spencer, just walk us through the scope and how it's changed in the last day.
Well, this is a very tricky thing to assess because the Teamsters have more than 1 million members, and they can easily draw people in to protest and picket outside Amazon's facilities, and that can have some effect alone if they encourage delivery drivers who don't work for Amazon directly but are members of unions to not make those deliveries, to not cross the line. The big question is how many actual Amazon employees are participating in this, and that's where Amazon's pushing back and saying that it's mostly outside agitators. But they have been picketing outside several sites in several states, so they have good geographic distribution. And another unknown is, does this just get into the psyche of the shopper around the holidays? Are people going to say, you know what, I was going to order something on Amazon, but maybe I should just run to the store in case the strike is creating any disruptions? Even though Amazon says there have been no disruptions, that's part of the danger of this.
Has anyone done the math to tell us what, you know, each next marginal day of strike could actually potentially cost Amazon, given that the Teamsters have 1.3 million people in their ranks, not all of them obviously Amazon workers?
Yeah, I haven't seen anyone try to do the math on that, and that'll be a tricky thing and something that likely we wouldn't see any evidence of until after, you know, they report earnings next year.
An insanely dumb question, Spencer, but what do the Teamsters want?
Well, the Teamsters want Amazon at the Staten Island facility to come to the negotiating table, because that's where they've actually, workers did a couple of years ago vote to form a union. And Amazon has not negotiated with them yet. So that's a big thing. And then they're trying to organize other sites. So they're definitely just trying to draw attention to this movement. And a big goal of this is to make workers feel empowered, that their labor means something. Their decision to, wake up in the morning and go to Amazon and do work for Amazon has some value if enough of them band together and say we're not going to do it, that's really the only leverage they have. And that's an important thing, because there's been this labor agitation for years now, and it gets tied up in the courts, it gets tied up with the National Labor Relations Board, and it just moves like molasses once it's at that stage. And I think the Teamsters want to show workers that, hey, you can have like a real taste of immediate result here if enough of us stand together. So that seems to be what they're really hoping to do, is get some kind of sense of solidarity within the rank and file in Amazon.
Now, the Teamsters are targeting 7 last-mile delivery warehouses. Some of them are not obviously in the tri-state area, some in California, Georgia, Illinois, but also around here where the weather has been freezing, but it is getting better later in the week, Spencer. I mean, that definitely has an impact. It's like elections, right? It depends on how many turn out.
Yeah, I mean, these are people who are delivery drivers, so they're not like us sitting in a nice, comfy office. They're pretty used to the cold. So asking a Teamsters driver to join the picket line when it's 20 degrees outside, that's not really a factor in preventing them from coming out. Maybe it's a factor in preventing some of the looky-loos or something like that. But I don't see weather as being a big factor for people who are already exposed to conditions, to them coming out. They're probably doing better on the picket line than they are working, because they've got people bringing them pizza and coffee and things like that.
But oh man, 12 degrees here. Yeah. I'm just saying, like 20 was a heat wave, but now we're at 12. Hey Spencer, before we let you go, how does this wind up playing out? Who really holds the balance of power in this, which will then dictate how long this goes on for?
Well, the balance of power, thus far has clearly been Amazon's. And I think the biggest thing benefiting them is just the churn in their workforce. People don't really see Amazon as a full-time career. And I think that's the biggest challenge for the Teamsters, is that they've got a lot of members who work for companies like UPS and have good jobs and benefits, and they spend, decades there. Whereas Amazon, you don't see that kind of tenure. And if you're trying to recruit people into a union movement and they don't see themselves being there very long, I think that still gives Amazon the power. As long as they're kind of constantly recruiting people and churning them out, it's tough to get a union movement going in an operation like that.
Spencer, thank you so much for keeping us up to date on all of this. Spencer Soper there in Seattle, and Amazon itself up 50% year to date. Well, another company making news this holiday shopping season, Nordstrom. The Nordstrom family announcing today it's joining forces with a Mexican retailer to take Nordstrom back private. For more, we're joined by Bloomberg Managing Editor for Global Business in the Americas, Shelley Banjo, who is in studio. Now, the market has had a few hours to digest this, Shelley. Nordstrom down 1.6%. I'm not sure if we can really say, much about the stock price move, but how is this being digested by investors in Nordstrom?
Yeah, people have had quite a while to digest it, in the sense that there's news of this over the last month, and so the stock has gone up in recent weeks. Right now, it's trading right about the price that was on offer for the take private deal. So in general, I think people think this will be good for the brand of Nordstrom, in the sense that it'll allow the family who owns Nordstrom to really focus on getting the retailer back on track without having to worry about the public markets. But it's a huge discount to where it was just a number of years ago. I mean, the stock has gone down quite a bit over the last 5 years. Back in 2018, the family made a similar offer, but much higher to take it private, and this represents a big steep discount to that.
What is the problem with Nordstrom's? Why did they have to wind up going private?
Yeah, I mean, I think it's a problem in general with department stores. I mean, the department store sales have pretty much halved in the last decade, and that's because more and more people don't see a need to go into the store. If you can get, as we spoke about Amazon, buy everything they need in Amazon. It used to be that some of the higher end brands wouldn't be seen, wouldn't be caught dead selling on Amazon. That's no longer the case. So you can buy anything basically now on Amazon. You don't really need to go into some of these stores. And a lot of these department stores sort of forgot the whole in-person shopping experience. The whole reason you go into a store is that you want that kind of service. And that requires people and labor and actually paying attention to the kinds of things that your customers want.
Do we know anything about the family or much about the family and who might be put into positions of power within the structure now?
Yeah, already they're members of the family running the business right now as the CEO and chief brand officer. This is a company that their family that goes back over a century. So it's been in the family for over a century. This time around, they have a partner. This company, El Puerto de Liverpool, which is a Mexican retailer that is joining forces. So Nordstrom will take a 51% stake. They'll take a 49% stake. This company had already owned 10% of the shares, but it'll be interesting that they're teaming up with this Mexican retailer to try to see if together that they can turn it around.
Does this mean that at Nordstrom Rack, when I go and shop there, I'll see more discounts or less? Because this is the real news that we need from this conversation.
Yeah, I mean, Nordstrom Rack
had really expensive, I gotta say.
They had really had something great going, really competing really well with the likes of TJ Maxx and others that really brought people in. Then all of a sudden, it sort of got rid of their big brands that were drawing people into Nordstrom Rack in the first place, and it was just sort of cheaper goods, and customers really recoiled at that. So in the last couple of quarters, they seem to have been getting a little bit better, and the hope now for this company is, can you actually provide stuff that people want to get, people want to buy?
Well, I guess some are doing it right and some aren't, so it'll be just a case of putting the right business plan into action. Shelley, thank you so much. Shelley Banjo is Bloomberg Managing Editor for Global Business in the Americas. Nordstrom itself is up about 30% year to date, down about 1.7%. As Shelley said, this news has been percolating for about a month. Next, though, do stay with us. We want to dig more into the year-end markets. Thomas Raymond, partner at Callan Family Office, is going to be joining us with his market outlook for 2025. And as me and Alex were saying earlier, all of those outlooks for 2025 see the S&P higher. In fact, many of them higher by more than 10%. I saw a couple of 7,000 marks there for the S&P for those forecasts, Alex. We'll be looking into that next. Do stay with us. This is Bloomberg Markets on Bloomberg Radio and Television.
The top names in business are on Bloomberg.
We are in the midst of the largest wealth transfer in history right at this very moment. So $100 trillion of wealth is going to next-gen and millennial clients over the next decade. So that has some pretty significant implications. But in addition to that, women are controlling more and more global wealth. Today, they control a third of global wealth, but in the next 5 years, $30 trillion is going to pass in the hands of women, and they're going to control over 50% of the global wealth market out there today. Women care deeply about investing with purpose, investing to make an impact, doing good with their investment. So you're going to see some significant opportunities for us as we lean in and have been leaning in to capturing more of the female wallet globally.
Nobody covers business like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome to Bloomberg Markets. I'm Bonnie Quinn alongside Alex Steele on this day of low volume but good intentions, I think. It's fair to say, Alex, we have the stocks rallying once again. We are finishing on the same theme as we started the year. It's really incredible.
Yes, and you have Meta also doing really well, AMD doing well along with Micron. You had, Rosenblatt Securities.
Yes.
That highlighted them as some of their favorite stocks for next year, saying Meta in particular, naming a top pick for the first half of next year, citing its position with artificial intelligence in the midst of a, quote, impressive and durable AI-driven growth renaissance. There you go.
There you go, exactly. And when we look at treasuries, we're seeing this continued shift as well. The 10-year yield is now up almost 7 basis points, 459.06. Many people asking themselves, are we going to see 5% at some point in the first half of the year? Torsten Slok of Apollo saying there's about a 40% chance. So we'll stay with the U.S. economy now. San Francisco Fed President Mary Daly spoke on Bloomberg on Friday. She discussed her take on the latest cut by the Federal Reserve and how the central bank views the economy as we close out 2024.
It's always about the data for me. We don't know what the incoming administration is going to do. You know, new administrations, no matter when they come, always put a slate of programs together. And really, as a policymaker, I want to see the net effects once I see clarity about what those policies will be. So I was focused on the incoming information and what it means for the outlook. And today, I feel like we've got policy in a good place, the economy's in a good place, and we're prepared for whatever comes before us.
What happened in the past 3 months that caused the Fed and perhaps yourself to be much more concerned about the stickiness in inflation?
Well, the data happened, and you look at the data, and what's happened is that, you know, there's 2 things that have occurred. First of all, the economy remains in a good place, and the risks to the outlook are equally balanced between a risk to inflation or a risk to employment. That's where we wanted our goals to be, and we adjusted policy when we had confidence that inflation was heading down, and we adjusted policy some more to ensure that we have a balanced labor market that continues. So that's where we are. But then the data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress is just slowed relative to what we had wanted. But that's a typical pattern. It's bumpy. As you get to the, you know, from 2.5 or 2.8 to 2, it's just a bumpy path. Yeah, go ahead, please.
But at the same time, some people were wondering if there was the stickiness, and I'm looking right now at, say, the Cleveland CPI now, and it actually has ticked up for the month of December from November. There was this question, why did the Fed cut it all?
Sure, and again, I'm going to reassert that it's bumpy. You know, remember earlier in the year, we had 2 months of data and people said, oh my gosh, it's reaccelerating, and then we had it come down. So inflation data, you can't focus on 1 month or 2 months. The most important thing for me was that we needed to recalibrate policy. I saw this as a close call. You know, was 75 enough to be the recalibration we were looking for, right-sized policy to meet the economy we expect, or do we need more? Ultimately, I determined that the 100 basis points was really the right level. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. You know, we've practiced that where you with a lot of uncertainty, you adjust the policy rate, then you wait watchfully, and you see what transpires, and then you make further adjustments. That's the phase I think we're now entering.
From September, the expectation in the markets was going into every meeting that you'd be cutting. Has that changed now? Should the expectation be that you won't be doing anything at any particular meeting? And from that question flows a second question. What are the criteria that you need to see to decide to go back to cutting rates?
Well, as you saw from the SEP, the median projection is 2 rate cuts next year. So that's already not every meeting or every other meeting. That's 2 rate cuts. I was very comfortable with that median. That makes sense to me. But we have to remain agile. I mean, the thing that's got us here is being resolute to achieve our dual mandate goals. Price stability was our focus when inflation was very high. The employment has come into the frame so that we're focused on both. But then we also have to be agile. The world is uncertain, so we pencil in 2, and as that estimate or that projection gets further from when we made it, the accuracy of it probably falls. And so we're just going to continually take in more information, consider it, and every meeting, your listeners should think about this, every meeting is live from the standpoint that you're debating, you're discussing, you're thinking, what's the right level of policy? But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
When we went into the cutting cycle, you were out front in saying you were concerned about the labor market and that we needed to make sure that we didn't lose the gains that we had. Now, absolutely, at least coming out of Chairman Powell's press conference, it sounds like the focus has shifted to inflation again. Are you comfortable with that as this new phase that he's talking about?
Well, I think of it as a new phase as well, and I would characterize it slightly differently. I would say that for a long time, a persistent amount of time, protracted, we were focused almost entirely on inflation. That's because the labor market was quite robust and inflation was 7, 6, 5. That was the right way to focus. Then the labor market came into the frame. That didn't mean we turned our focus totally to it. It just meant that after a long period of focusing only on inflation, we were now focused on both. I think that is still the case, but I see policy is already in that position where it's supporting both. The policy is restrictive. It's going to continue to bring inflation down, and it's going to do so in a way that doesn't strangle the labor market, break it, and then give people lower price, lower inflation, but take their jobs. And that's not what we're trying to do. We're really working towards that soft landing.
That was San Francisco Fed President Mary Daly speaking to Lisa Bromwitz and Michael McKee on Friday. That's after that Fed decision. So she's really of the camp, Vonnie, that it was the past inflation data that led them to cut. But then you have to think about what's going to be the case next year in terms of tariffs. Remember, they revised up their inflation forecast, which is such a head scratcher, right? You revise up your inflation forecast and you still cut.
And this is even before we have the inauguration and whatever might come after that. And as many people have been saying, nobody, including anybody at the Fed, knows the cadence or the magnitude of any policy changes that might go into effect. Mohamed El-Erian, I don't know if you had a chance to see it in the FT today, really worried, saying that this Fed is actually showing a persistent lack of strategic policy anchoring, which he says is very necessary at an uncertain time like this.
That's what happens when you're super data dependent, right? Well, our next guest says that the key to navigating the markets in 2025 is to focus on over stories like artificial intelligence. I don't know what that means, so we're going to ask him. Thomas Raymond, investment management partner at Callan Family Office, joins us now in studio. First off, thanks for coming in on a 12-degree day in New York. That's no easy feat.
Happy to be here. Yes, it's cold. And yes, it's forecasting season. Everybody's looking into 2025.
Everybody's looking at it. Okay, so what does focusing on over stories mean?
Yeah, so investment over stories are, it's something we kind of borrowed from Malcolm Gladwell's recent book, right? It's kind of like the canopy that it surrounds the markets and dictates all the outcomes, right? And it's AI is one of those. Monetary policy is another. Politics is another. But AI is us for the starting point for what to expect in the next year and the years to come.
Why is that? Haven't we had enough of AI already? Is it not
the concept of AI and embracing it going across the entire corporate landscape is Reddit. Reddit is not an AI darling, but AI, or Reddit, which IPO'd this year, has it had Reddit, which IPO'd this year, has it had a 3-fold gain in time this year. How do they do it, right? They did it through AI, like their user base is users, but to map their content into different languages.
Also, aren't they selling their content now?
They're also selling it, absolutely. They're selling it to OpenAI and other AI firms so they can kind of train their models on it. So for the first time ever, Reddit, a name not often synonymous with AI, has turned a profit in the fourth quarter. It took them 20 years to get there, but AI was that fulcrum point. So you're going to see more and more of this, and you're seeing it already manifest in earnings, right? So earnings through the third quarter, the S&P, 8% year-over-year growth, outperformed, 77% of the S&P 500 companies outperformed. But if you look at look at small cap, 34% year-over-year growth. So you're seeing this broadening of it into names like a Reddit that you don't know of concept. For a variety of reasons. Right? I mean, they said not too long ago, just 3 months ago, that their policy is going to shift. Right? For them to kind of jump back after a few kind of data points, some hot inflation numbers. Central, I mean, the monetary policy is a centerpiece to how the financial markets operate, and they can't be whipsawing back and forth. So that's one. Two, $6 trillion federal debt, right? And a lot of that has to be refinanced at now higher rates. So that is something that has